The Westpac Consumer Sentiment Index was up 2.7% in July. That was surprisingly soft, I thought, given that we saw the Reserve Bank pause. Now, back in April, when they had their first pause, the index was up by 9%. And indeed, when we analysed the index this time around, the actual pause did not improve the index at all. And I think what's happening is that people watched what we saw in the media, where they basically said, okay, this is a pause, but it's not going to last, and the RBA is going to be raising rates again. And I think that's why we didn't see a better response. Indeed, the only reason why the index went up was a better feeling about inflation. So the previous week, inflation printed had come down from 6.8% to 5.6%. And I think it was that was more important to the improvement in sentiment than it was the actual pause from the Reserve Bank. Our research now shows that now we've had now almost more than a year of very weak consumer sentiment, and it's been clear to us that the major drag on sentiment has not been interest rates, it's been the rise in the cost of living. It's been that very, very high rate of inflation. And it makes a certain amount of sense because only a third of the economy have a mortgage, whereas everybody is affected by these rising prices. In terms of other aspects of the survey, we saw that we've basically now seen about a 30% fall in confidence around the outlook for the labour market. That used to be extraordinarily strong, well above average. It's now back to around the long run average, but we are starting to see this relentless deterioration in how people feel about their job security. The big story, of course, was also around the housing market. So despite the fact that we've seen almost a 40% jump in the index that measures how people feel about the outlook for house prices, we saw another 1.5% jump in that. So now we've got 5 times more respondents who are positive about the house prices than are negative. And that really comes as a surprise, given that they're still raising interest rates. The Reserve Bank surprised us when they didn't raise interest rates at their July meeting. But when we look back on the decision, we note that the meeting before they get the revised view on inflation, the sort of quarterly inflation report, and the meeting at that same meeting, it's a week before, it's a month before they see the board meeting as well, the new board meeting, and the new set of forecasts that the Reserve Bank staff provides. We saw that pause in April. I think there probably would have been a pause in January. There was no move in January, but there was no meeting. And back in October, a similar time, there was a taper. So they surprisingly reduced the pace at which they were raising rates from 0.5% to 0.25. So that meeting before the Reserve Bank has a meeting that when they revise all their new forecasts seems to be the one when they decide to take a bit of a breather from policy. What does that mean for the next month? I don't think it changes our view that they'll be raising rates at the August meeting. The data in the lead up to July was incredibly convincing that another rate hike should have occurred. And most importantly, the Reserve Bank Deputy Governor pointed out that they believe that full employment, that is the unemployment rate below which you will continue to get inflation, that full employment is 4.5%. So the view is that from the authorities that you need to get 4.5% unemployment before you can achieve your inflation target. And at the moment it's 3.55%, and we saw data on the level of vacancies in the economy. Over 400,000 job vacancies only fell by a couple of percent from 3 months ago, and the ratio of vacancies to unemployed is nearly 1 to 1. Now before COVID, there were 20% of vacancies relative to unemployed. So we've still got these really tight labour markets, which is still signalling that wage pressures are not going to be consistent with the Reserve Bank's objective of achieving inflation. So that's why we think they're going to have to raise rates again. And of course, as I said before, confidence in the housing market continues. So house prices that were falling up until January this year stabilised in February. They've been rising ever since. And the survey indicated that people are still confident about house prices. That is an anathema to a central bank that sees the housing market as an issue around spending and an issue around the wealth effect. So you need to slow down that housing market. So that's why I think that the case is pretty strong for another rate hike and another one thereafter in September, until they start to see real evidence around that labour market and real evidence around the wages story that the inflation target can be achieved. Thank you very much.